Welcome back to the deep dive. Today, we're going to crack open The Smart Money Method by Stephen Clapham.
Oh, yeah.
Learn how to pick stocks like a hedge fund pro.
Sounds intimidating.
I know, right? Hedge fund, it does sound a little Wall Streety, but
Pinstripes and all that.
yeah.
Yeah.
But don't worry, we're going to try to break it down and extract those golden nuggets that everyone can use,
Yes.
even if you don't wear a suit to work.
Exactly. And Clapham is all about efficiency.
Okay.
He says that 20% of the work gets you 80% of the results when it comes to investing.
I like that.
And so that's what we're going to try to focus on today.
Awesome. So tell me, what is that first big idea that Clapham lays out?
Well, he kicks things off with the idea of information edge,
Okay.
which might sound obvious, but it's something that people tend to overlook.
Yeah.
It's basically about knowing something that the rest of the market hasn't figured out yet.
Right.
And he illustrates this with a really interesting story about a mining company
Okay.
that went public in London.
Ooh, give me the details.
So this company, they had a coal mine and a power plant in Eastern Europe,
Okay.
and they were a vertically integrated producer of ferrochrome.
Ferrochrome. Okay.
And when a big South African power utility announced a massive electricity price hike,
Okay.
most investors didn't really pay much attention to this.
Oh,
They
interesting.
didn't see the connection.
So they didn't realize that this price hike would essentially make the Eastern European company's product that much more competitive.
Precisely. Clapham saw this as a screaming information edge,
Oh,
because South African ferrochrome production relied heavily on electricity,
yeah.
and their costs were about to go through the roof.
Of course.
This Eastern European company had a huge advantage, so he bought the stock.
Smart.
And wouldn't you know it, it quadrupled in price.
Wow, that's amazing. But how do we find these information edges? I mean, it
Yeah.
seems like trying to find a needle in a haystack.
Well, he argues that it's more about being a detective than a fortune teller. He says we should pay attention to seemingly unrelated events and think about how they might impact specific companies and industries.
Oh, interesting.
You know, like those ripple effects
Right.
and also regulatory changes,
Okay.
because those often create winners and losers in the market.
Right.
And maybe the most important thing is to look at less followed industries
Hmm.
where there are more likely to be information inefficiencies.
So it's like looking where other people aren't looking
Yeah,
and connecting the dots that other people are missing.
exactly.
Okay, that makes sense. But let's be honest, even if we spot an opportunity
Yeah,
analyzing companies and crunching numbers,
Yeah.
that can be a bit intimidating.
that's fair.
So what does Clapham say about that?
Well, he makes the process surprisingly approachable.
Okay.
He thinks a lot of analysts, even professionals, they overcomplicate things.
Okay.
He's all about a ground-up approach,
Okay.
which basically means starting with the basics.
All right. So where do we even begin?
He really emphasizes scrutinizing the accounting policies, not just looking at the numbers, but understanding how the company is recording their revenue and their expenses and their assets,
Right.
and looking for any red flags.
Like what kinds of red flags?
Well, inconsistencies in their audit reports,
Hmm.
or like if their audit fees are suspiciously static, even though they're making a lot of acquisitions.
Okay.
Like, those are some things to watch out for.
So you really have to go beyond just those, glossy presentations and
Really?
really dig into the nitty-gritty details.
Yeah.
What else should we be on the lookout for?
He's a big fan of segmental analysis.
What's that?
It's basically dissecting the company, understanding how each part of the business is doing
Okay.
and how each part contributes to the overall performance.
Right.
It can help you uncover some hidden gems or see if there are areas that are dragging the company down.
Got it. So don't just look at the whole pie.
Right.
Look at each slice. What about things like profit margins and CapEx? Are those important?
Definitely.
Okay.
He really stresses looking at trends in gross margins,
Uh-huh.
working capital, and capital expenditures.
Right.
This can help us understand how efficiently a company is using its resources and investing for the future.
Oh,
He even goes so far as to say that the day of the week a company reports its earnings can be a little signal.
wait, really? How does that even matter?
Well, he points out that statistically, fewer companies report earnings on Thursdays and Wednesdays. So choosing a less busy day,
Okay.
it could be a way to kind of fly under the radar a little bit.
Wow. It's amazing all these little things that you can glean information from.
Right.
Yeah, it's like,
It's like being a detective.
it is financial detective work.
Yeah.
Now, what about the people who are running these businesses?
Yeah.
Does he talk about management at all?
He dedicates a whole chapter to it.
Oh, wow.
It's crucial But it's often overlooked.
Yeah.
It's not just about the numbers.
Yeah.
It's about the people making the decisions.
Makes sense. What kind of things should we be looking at?
Well, there are quantitative factors like executive compensation and how their incentives are structured.
Okay.
But then there are also qualitative things
Yeah.
like the board's composition and management's track record.
Got it.
He even talks about whether investors should meet with management directly.
Ooh, that's a big one.
Yeah.
Some people swear by it.
Right.
Other people think it's a total waste of time.
It's a hot topic.
Where does Clapham land on this?
He thinks that those personal interactions can be really valuable,
Okay.
but you got to go into those meetings with insightful questions.
Yeah, of course.
Like ask them about their incentives and how they see potential threats.
Okay.
Even turn the tables and ask them, what question would you have asked if you were in my shoes?
Oh, that's a good one.
Right.
Yeah.
He even tells a story about a company that presented misleading data
Oh.
during a conference,
Okay.
which just goes to show that you got to be careful.
Right. Trust but verify.
Exactly.
That's a great one.
So yeah, you really got to reconcile what management's saying with what's actually in the numbers.
That's smart. So we've covered information edge.
Yeah.
We've talked about digging into financials.
Uh-huh.
And we've talked about sizing up management.
Yep.
So what else does this smart money method have in store for us?
He also dives into the idea of founder-led businesses.
Okay.
He's noticed this pattern where companies with founders at the helm, they just seem to do better.
Really?
Yeah.
Why do you think that is? Is it just like the passion?
Well, it's more than just passion, I think.
Okay.
He believes that founders often have this deeper understanding of their businesses.
Right.
They're more committed to long-term value creation.
Okay.
And their interests are aligned with the shareholders
Makes sense.
because, they usually have a big chunk of their own wealth tied up in the company.
So skin in the game, good.
Exactly.
But wouldn't that also make them kind of resistant to outside opinions, maybe new ideas?
Yeah, that's a valid point. And Clapham acknowledges that founder-led businesses can become a bit insular.
Right.
So it's important to assess whether the founder is adaptable and open to change.
So it's kind of that balance between vision and flexibility.
Yeah, absolutely.
Okay, that makes sense. Now, we've talked a lot about analyzing individual companies,
Right.
but what about the bigger economic picture?
Yeah,
Does Clapham talk about that at all?
he does. He's got a whole section on macroeconomic analysis.
Okay.
He thinks it's important to understand those big trends and how they might impact your investments.
Okay.
But he also cautions against trying to, predict specific macro events.
So don't try to be like the Nostradamus of finance.
Right.
Okay.
It's more about understanding those potential impacts of things like interest rate changes,
Yeah,
inflation, currency fluctuations, that kind of thing.
makes sense.
For example, he talks about paying attention to exchange rate movements,
Right.
especially for companies that operate internationally.
Okay.
And he even shares a story about how he actually profited from the UK's Brexit vote.
Really? So he turned a political earthquake into a profitable investment. How did he do that?
Well, he recognized that the market was underestimating the likelihood of a leave vote,
Wow.
and he positioned his portfolio accordingly.
Interesting. So it's about kind of those moments where, the market's perception and reality are out of whack.
Yeah, exactly.
Now, once we've done all this research,
Yeah.
how do we actually figure out what a company is worth?
Well, this is where it gets really interesting.
Okay.
Clapham doesn't just rely on that typical price-to-earnings ratio, the PE ratio.
Right.
He encourages investors to use a bunch of different valuation metrics
Okay.
and to think about things like debt levels, tax rates, and industry dynamics.
So there's no like one-size-fits-all approach? Okay.
You got to understand the context
Right.
and choose the metrics that make sense for the specific business you're looking at.
Gotcha. So he's saying be flexible, right?
Exactly. He also likes to compare a company's current valuation to its historical range and its peers
Okay.
to see if the market might be overvaluing or undervaluing it right now.
So kind of looking for those moments when it's out of sync with its past or its competitors.
Exactly.
Now, is there a particular metric that he really likes?
He's a big fan of the enterprise value to sales ratio, the EV sales ratio.
Okay, tell me more about that. I'm not super familiar with that one.
So he likes it because it's less volatile than the PE ratio.
Okay.
It can give you a more stable picture of what the company is worth,
Gotcha.
especially for businesses that go through those boom and bust cycles.
Makes sense.
He actually used the EV sales ratio to spot a buying opportunity in Amazon way back when.
Oh, wow. That probably worked out well for him.
Yeah, a little bit.
Uh-huh.
He also likes to use metrics that go beyond just the financials,
Okay.
particularly for those asset-heavy industries like utilities or hotels.
So instead of just earnings, you're looking at things like the value of their power plants or hotel. Interesting.
He gives an example of analyzing a power company's value per megawatt of capacity.
Okay.
And it actually revealed a buying opportunity that you would have missed if you were just looking at traditional metrics.
So it's like finding those hidden gems that the market is overlooking.
Exactly.
I like that. It's like treasure hunting in the stock market.
Well, yeah.
So we've got the EV sales ratio,
Uh-huh.
asset-based metrics. What else should we have in our toolkit?
Another one is free cash flow yield.
Free cash flow. Okay.
He thinks this is a more accurate way to measure a company's ability to generate cash
Then earnings.
than earnings, yeah.
Okay, so why does he prefer free cash flow over earnings?
Well, because it focuses on the actual cash the company can generate
Okay.
and potentially return to shareholders,
Right.
rather than just accounting profits,
Hmm.
which can sometimes be manipulated.
Right.
He emphasizes the importance of adjusting for things like working capital, maintenance costs,
Gotcha.
one-time items, to really get that true picture of free cash flow.
So looking beyond the smoke and mirrors.
Exactly.
Now, let's say we've done all our research,
Yep.
analyzed the financials,
Uh-huh.
we've come up with a valuation.
Right.
Now what? Do we just go shout it from the rooftops?
Well, this is where his hedge fund background really comes in.
Okay.
He emphasizes the importance of being able to communicate your ideas effectively,
Makes sense.
even if it's just to yourself.
Okay.
He thinks writing a formal investment note, no matter how simple or complex,
Yeah.
it's a really valuable exercise.
Why is that?
Well, it forces you to articulate your investment thesis in a clear and concise way.
Okay.
It helps you avoid cognitive biases.
Right.
And it can really prevent costly mistakes.
It's like having that written record of your reasoning. And
Exactly.
you can go back and review it
Right.
if you need to.
Yeah, he actually provides a framework for these notes.
Oh, cool.
He says start with a clear investment message.
Okay.
Highlight the top reasons to buy the stock, and then maybe a couple of risks.
So kind of like an executive summary of your thesis.
Exactly. Then you dive into the valuation analysis, talk about the company's history and management,
Okay.
and clearly state your assumptions and how they might be different from what everyone else thinks.
Right, because that's important.
And he even suggests giving your ideas a conviction level.
Oh, interesting.
Like, how confident are you in this idea?
Yeah.
And that can help you prioritize your investments and manage risk.
So putting your money where your conviction is.
Exactly. So we've covered a lot. Information edge, financial analysis, valuation, communication.
It's been a lot, yeah.
It's a lot to think about.
Are there any other big ideas from the book that we should touch on?
Yeah.
Yeah, it's like Clapham has really given us a mental workout here, you know? Going from spotting opportunities to really dissecting financials.
Yeah, it's a lot.
Are there any other, like, key concepts that he really wants to drive home?
One thing that comes to mind is the importance of constantly monitoring your investments
Okay.
and being ready to adapt to changing conditions.
So you can't just buy a stock and assume it's going to go up forever.
Exactly.
Okay.
You got to stay informed about what's happening in the industry.
Right?
Keep an eye on the company's financials
Yeah.
and revisit your investment thesis every so often.
To make sure it still makes sense.
Exactly. And of course, keeping an eye on that broader macroeconomic environment.
Right, because that can change quickly.
Oh, yeah.
Got to be on your toes.
Absolutely.
So it's about staying engaged, being ready to shift gears if you need to.
Yep.
Now, before we wrap up, I want to touch on something we talked about a bit earlier.
Okay.
Those intangible assets like brands and intellectual property.
Yeah.
Clapham argues that this is making those traditional valuation methods less effective.
Yeah. It's a big challenge.
What are some of those specific challenges that investors face when they're trying to value these?
But a brand or a patent, that's a lot more subjective.
How do you put a price tag on brand loyalty?
It's tricky. There's no easy answer.
Yeah.
And those traditional accounting methods, they don't always capture the full picture.
In what way?
Well, they might only record those intangible assets at their historical cost,
Okay.
which might not reflect their true market value today or their potential to make money in the future.
Right. It's like, what's the potential of this brand to generate earnings?
Exactly.
Yeah, tough to say.
So some investors are looking at alternative methods, like discounted cash flow analysis,
Okay.
which tries to estimate the present value of future cash flows.
Okay.
And others are using market-based approaches,
Gotcha.
comparing a company to others with similar intangible assets.
So really looking for those comparables.
Yeah, but ultimately comes down to understanding the business, the
Right.
competitive advantages, and what really drives value in that industry.
So much more art than science.
Yeah, you got to use your judgment.
Right.
Think about different scenarios.
Yeah.
Make assumptions about, how long a brand will last.
Right. How long will people care about this?
Exactly, or how fast technology will change.
Wow. It's a lot to think about.
And you got to factor in the competition, too.
That's super interesting.
It is,
I think we're going to hear a lot more about this as we move forward.
definitely.
Now, before we go, I wanted to circle back to something else Clapham highlights.
Okay.
That's clear communication when you're presenting your investment ideas.
Yeah, that's huge.
Why does he put so much emphasis on that?
Because even the best idea in the world is useless if you can't explain it to people.
It makes sense.
Whether it's convincing a portfolio manager to invest
Right.
or getting your colleagues on board.
Okay.
Even for individual investors, it's crucial.
So being able to articulate your thought process
Yeah.
in a way that's clear and persuasive.
Exactly.
He even gives a framework for how to structure those investment notes.
Yeah, to clearly lay out the opportunity, the risks, the key drivers.
He thinks that even if it's just for yourself,
Yeah.
just the act of writing it down can help you make better decisions.
Like creating a blueprint for your thesis.
Exactly.
Well, I think we've covered a ton today.
We have.
Going from information edges to valuation techniques,
Yeah.
the power of clear communication.
It's just been a journey.
It has. Any parting words of wisdom from Clapham?
He reminds us that investing is not a science, it's an art.
Okay.
It needs those analytical skills, but also intuition and a good dose of skepticism.
I love that.
It's a good one.
It really sums up what it takes to be successful.
Yeah,
You got to analyze the numbers, but also trust your gut and be willing to question those assumptions.
absolutely.
Well, that about wraps up our deep dive into the smart money method.
Great book.
Such a good book, so insightful.
Yeah.
Thanks for joining us on the deep dive.
My pleasure.
Until next time, keep learning, keep exploring, and keep diving deep.